Hi, folks. This is Mike Zlatnik, Big Mike. And today we're going to talk about multiple topics. They're based on the presentation I gave last weekend at an investor summit, and it was well received. So I am delivering it as is, almost intact. And it's got multiple important discussions. So we'll cover them, and I'll explain why all these items are covered in a single presentation. So we're going to talk about 2023 real estate investment outlook. Great and discounted deals are coming. Investing with downside protection and managing your portfolio through a recession. And the reason it's a broad presentation because many investors have these questions on their mind. It almost are as common as eating breakfast. Folks want to know what to do with their portfolio. And should they be investing now or waiting? Are the great deals around the corner or they have to wait? And what is the general economic outlook? So we'll cover all these points because they're very relevant, very important. Disclaimer, this presentation is for informational, educational purposes. There are no recommendations. We don't give advice, nor are we selling anything at all. If you're interested in our family of funds or syndications, request PPM to accredited investors only. Consult with your attorney and CPA professional. Our team, we're not going to spend a lot of time here. We're actually strengthening the team. We're hiring 2 folks in the asset management department. So we'll be at 10 folks. And the reason we're hiring in the asset management is as a fund manager, we have to strengthen what we do. We want to make sure we survive a downturn. We do well in a downturn. That's why we're strengthening our asset management, which is a critical part of fund management. So just wanted to bring this point up. Why folks invest with us? We've been doing real estate fund management since 2009 very successfully. We love what we do. We're very passionate about it. Our funds present a single access point into a diversified portfolio of assets. We diversify among many dimensions, such as income and growth strategies. We diversify among different asset classes like self-storage, multifamily, industrial, discount lots. We do a lot of things in the growth sector, holo conversions to multifamily, and so on and so forth. We also diversify among many locations. These deals are all over the country, as well as multiple operators. So by investing with us, you get best access point into broad strategies with great term. We negotiate best terms for our funds because we write systematic checks as well as we write bigger checks. Business philosophy investments comes first. We pride ourselves on white glove service. We're very transparent. We use reputable SEC counsel as well as third-party administrators. And we communicate often through portal statements, investor Zoom calls, and so on. On the business philosophy side, let me mention this. We continue to believe in these very fundamental principles. Like Warren Buffett, we're all about investing with the right people, the right projects, and the right amount of capital. Warren Buffett does it in the reverse order. He decides what to buy first, what price to pay, and then who is going to run those companies. For us, it's always about people. Who do we invest with? Who are the sponsors or the operators? What projects we want to select, and what terms we can negotiate, and how much capital we want to deploy. Our entire deal flow comes from relationships. We only do deals with existing relationships or on strong referrals. We don't do any cold business. We don't take any of business from the street. The same happens with our investors. Folks come to us based on masterminds and relationships, and 99% of a business revolves and gets done this way. One of the other critical points is that we diversify in our funds. That's how we run these diversified funds, because we believe in diversification. It works. It is especially more important in a down market, in a recession, which we're expecting to see. And we diversify, as I mentioned, across multiple strategies. And then finally, our investors come first. We offer investors institutional quality terms and great service. And folks that invest at least $1 million with us in any of our funds receive relationship balance of $1 million. Typically, that has a pref and a split of 80-20 over that, which is an institutional quality offering. Now, let's talk about inflation. Inflation is cooling. This is CPI year over year. The over month, the numbers are substantially lower. Inflation is almost flatline at this point on a month-over-month basis, which is good. But year over year, we're still showing high inflation last year and low inflation this year. That's why you're seeing these figures. It's basically rapidly decelerating year over year basis. And that's actually good news, as inflation was out of control for a while. Federal Reserve was sleeping at the wheel. When they woke up, they started very aggressive action. And that is going to cause a lot of pain. But now we're dealing with the consequences of Fed action, but this is giving Fed less ammunition to continue to push rates much more. Unemployment is critical. Unemployment is too low for any kind of economy. Even in a great expansion, 3.7% unemployment is way too low. And the reason inflation has been around is because unemployment has been too low. Unemployment actually drives inflation. There's a relationship between the two, which we'll see on the next graph. I've talked about that in the past. So the projection is that unemployment is going to go up from this point on. A number of companies have announced layoffs. We're going to see more layoffs in the upcoming months. So we'll see where we're going to get, but the average consensus is get to 5% unemployment rate by the end of the year, 2023. Again, Phillips curve, relationship between unemployment and inflation. As unemployment growing, the number is increasing. We're moving from point B to point A on the Phillips curve, which is going to help to bring inflation down, and that's the good news. Fed action. So Fed action has been too fast and too furious. For those of you who have seen that movie, you know what I'm talking about. They were at the wheel, sleeping too long, saying inflation is transitory, and when they woke up, realizing inflation is out of control, it was too late to take action, but they did it. They had no choice, and they went extremely aggressive. And now we're going to be dealing with the consequences of Fed being at the wheel asleep too long. So we went from 0 to 4.5% Fed funds rate in 9 months. This is from March to December 2022. Now the next meeting is in early February. The consensus is going to go up about a quarter. We'll talk about that. Probably another quarter, maybe 50% to run after that. We'll cover that on the next slide. So Fed is almost done, but they've done all the damage already. Whatever additional raises they're going to do, they obviously not going to help, but they're going to hurt a little bit more. But most of the pain has already been inflicted. And the reason for this is the U.S. economy has too much short-term debt, specifically bridge loans in real estate, a lot of corporate debt that had 2-3 year maturity. These notes are maturing, and that's what's going to cause humongous problems on maturity. And the impact of Fed action also takes 6 to 12 months to materialize. So it hasn't even been a year since they started raising interest rate, and we're already seeing a lot of issues. And the effect is shocking because the debt service, in many instances, have gone up, doubled, in some cases even more than doubled, and nobody expected that. And doubling debt service can absolutely annihilate certain deals. And then look at the curve, the slope of the curve for these rate increases. It's of unprecedented proportions. Fed has raised rates in the past, but they haven't raised as fast from 0. So the only time it was 0 was after 2009 crisis. You could see the interest rates were basically, you had a ZERP policy for many years. And then they increased the rates gradually from that point on. And that slope is right here. The increase of the Fed slope, hope you can see my mouse moving, was substantially slower than what they just did now. And in the past, they've increased rates, but they didn't increase it from 0 point. So the rates haven't effectively, the payment factors never doubled in such short time. So this is historically completely unprecedented. And the economy, in my opinion, I don't believe can take this pressure for too long. And that's why we are projecting and expecting a number of distressed deals coming forward in the economy. We'll talk about that in just a couple of slides. Anyway, so Fed will likely increase rates another 50 to 75 basis points, and they'll be done by the end of the quarter, in my opinion, with terminal velocity, terminal rate being between 5 and a 5.25, somewhere in that range. The Fed policy has long and variable legs. Simply that means that it takes time for the effects of Fed action to be felt in the economy. and we're beginning to see that pain already. Rate cuts are unlikely in 2023, and the reason they're unlikely is typically Fed takes pause for 6 to 12 months unless something breaks. So if something breaks sooner than that, the Fed will start loosening sooner. But if the economy doesn't go into steep recession too fast, they'll probably maintain the rates through the end of the year at their terminal velocity level between 5 and 5.25. Slowly growing unemployment, estimated to hit 5% by the end of the 2023. And then the CPI is expected to come down to a much more realistic level, 3 to 4% year over year by the end of the year. We're probably not going to hit 2 to 3% target, but 3 to 4 is a much more realistic number. And that is not ideal for Fed, but close enough, in my opinion. So commercial real estate deals. Transaction volume has been falling and will continue to be low because the bid and ask have widened substantially. So many sellers are not yet capitulating. They want to sell the property, but they want to get their price. And many buyers want to get great deals, which is normal and natural. People are sitting with cash on sidelines and not taking action, looking for a great deal. And that'll continue probably for a number of months until we're going to see more pressure on the economy and sellers will start capitulating and better deals will be coming probably second half of 2023 and into some level of 2024. And as a buyer, as an investor with fresh capital, you have to be very nimble and opportunistic. When a great discounted and distressed deal shows up, you don't need to wait for a year to get it. If it's showing up now, you may be able to negotiate phenomenal terms now and make the investment now into something that looks a lot better than 3 to 6 months ago. And the pain point is long-term maturity and rate cap expiration. We'll talk about that next slide. And this trend will continue to accelerate. Okay, the biggest pain point, the main slide of this presentation is there's a huge pressure boiling in the economy. And the pressure is coming from mortgage and other long-term maturity or rate cap expiration. So rate cap expiration means that folks bought properties or invested into loans and they effectively had variable rate loans. And then they bought a rate cap insurance in essence. And these are insurance policies that effectively generate income, or they pay the owner of the policy based on the interest rates when the rates go up. So that if the rates hit the cap, these policies started to pay investors, and they use that cash to pay the mortgage rates on their variable product. So to make a long story short, that is expiring rate caps or expiring loans will create unbelievable pressure points. So imagine somebody bought a property with a bridge loan 2 years ago, and their rate was 6.5%. The rate was 3.5%, and they are now on renewal have to pay 6.5% to extend the loan. That's 80% increase in the payment factor, and the rents growth just can't keep up with this. So if the value add strategy is executed and the rents are up 20, 30%, maybe 40%, I mean, these are strong numbers. If our operator is successful and they've pushed the rents up by 30 to 40%, they've done really good work. The problem is the payment on the loan is substantially higher, and they can't really afford these high interest rates. You're going to ask me, why in the world people took these bridge loans with 2 to 3 year products instead? Why didn't they go and get Fannie Mae, Freddie Mac, long-term paper? And the answer is that they wanted to refinance. They wanted to buy, get a more flexible, high LTV mortgage with initially very low rates, execute value add strategy, and upon completion of value add strategy, refinance into long-term product or sell the property. The problem is the strategy failed when the Fed started to push the rates up at such a rapid pace. And that's what most or many investors find themselves, that they are facing maturing loans and they need more capital to be able to renew. Otherwise, they can't meet the debt service coverage ratio requirements. So project operators and sponsors really have a few options. One, issue a capital call to existing investors. Basically come to investors and say, if we don't get any more capital from you, the loan is going to go into default for the reason that we can't pay the payments. The bank will not allow us to be paying with the debt service coverage ratio being below 1.2%. So most banks' requirements, sometimes it's 1.15, but 1.2 is very common. In other words, if investors don't have enough income on a property relative to the debt service, they can't meet the SCR covenant and they're hitting a technical default. So again, raising capital from investors is one option. Two, going to new investors and saying, we have this great project, but we need liquidity to be able to extend the mortgage, and would you invest in equity? And that will be dilutionary to existing investors. So going to new investors is another option. Third option is to sell the property. But if the property is going to hit the market and it's a distressed sale, meaning that the property wasn't finished, it needs some more work, there's some substantial underperformance in the asset, it can be sold at a big discount. And that'll create some of the new great deals. But for existing owners, it's a massive pain point as they have to sell the property potentially at a substantial discount to what could otherwise be a fair market value. And most prudent operators will be projecting and preparing for this and looking to raise the capital proactively. So when the maturity hits, they don't have a crisis on their head. And if they persevere for a few years, when the rates cycle back down, the deal may again be priced at a lower cap rate. So again, these three options are the only available option to the situations where mortgages mature, and they need to be renewed at a much higher interest rate. So the deals are coming. They're for sure. Surely they're coming. But the best way to look at this, look at the data. There's approximately 450 billion of long-term maturity coming in 2023. It's a gigantic number. And that number will create a lot of opportunities in real estate where the owners will need to sell under a pressure situation, or they'll need to bring fresh equity into the deal to be able to renew the loan, matching the bank requirements. Prices could drop 20 to 30%. Now, I'm not saying they will drop. They could drop. It depends on the assets, depends on the location, depends on the value add versus performing asset, how well the execution was done. So there's going to be a lot more opportunities hitting the market in the upcoming months. And distressed asset may take a while to hit the market. So at this point, most investors are staying patient, waiting for great deals. But we're already seeing some of these deals show up. So as an investor, you may need to keep your eyes and ears open for some opportunities in Q1 and Q2 of 2023. But the general expectation is that the bulk of the challenging deals or discounted deals will hit the market in the second half of this year and into next year. To be or not to be? That is the question. Or to investors, it is invest now or invest later. And the answer is most likely later, when better deals come to the market. However, there are already interesting, good deals today that you can invest in. So I'll give you some examples of some of the deals we've done recently. So we've done a bridge mezzanine loan with a strong personal guarantee from a good operator sponsor whose loan was maturing. So the way they raise capital, instead of going to investors trying to do a capital call, instead they got basically an additional mezzanine debt. We charged them 15.5% interest rates and 2 points. With a strong underwriting, we felt pretty good on the deal. Another example of the recent deals that we have completed is 2 deals called Michigan 2 and Oak Park and Stephenson. These deals have great structures. So investing in preferred equity in these deals with a 16% pref and seniority of return of capital and 8% current yield looks pretty attractive if you're looking for greater safety. So something to keep in mind that you can already act now. You don't need to look for perfect timing, a deal that's trading at a massive discount. So even though people expect substantially better deals in the future, they don't know when they're going to happen, and they don't know how good they're going to get. The Fed may run out of patience, and when the economy starts showing a lot of weakness, they may start cutting rates faster than you would expect. So we just don't know what's going to happen. Future is uncertain. That's why looking for a perfect timing is very difficult. It's very difficult to time the market. So focusing on the right operator and the right deal, not waiting for perfect timing, is a better strategy than looking, I'm just going to wait until everything falls. Well, what if a lot of the things don't fall? So you have to be prudent about this. You don't want to buy at the peak of the market. At the same time, you want to be ready to invest if the opportunity comes in a month, in two, not waiting for perfect timing. And we don't even know when the perfect timing is. So investing with downside protection, really important element to understand capital stack. You can invest in JV equity or common equity. You can invest in preferred equity. You can invest in mezzanine debt. So preferred equity and mezzanine debt could be on the same level. Some deals will have preferred equity. Some deals will have a mezzanine debt. And you can invest, obviously, in senior debt. So senior debt has a higher safety, but generally, the rate of return is somewhat lower with the greater safety. Anyway, the downside protection comes from many elements. And obviously, operator strength is an important consideration. The strategy itself, are you buying existing at a discount versus building new? It's very difficult to get a discount on construction. You can't. It's going to cost what it's going to cost to build. So you can get discount on land, but land itself only presents a small portion of the total cost on a ground up project. So investing in ground up projects today is difficult to justify. Some folks are still doing it, but for us, the better opportunity is to buy existing at a discount. Capital structure, as I mentioned, investing in mezzanine debt, preferred equity versus common equity may be a valid consideration if you're looking for downside protection. Also, location, obviously, there's some cyclical and non-cyclical markets. And folks in these hot markets that are cyclical, that have been going up and up and up, saying, well, our markets never go down. And the reverse happens. Many of these markets correct and adjust. And you see substantial drops in prices in those markets. The non-cyclical market, typically your boring markets, that don't go up and down as much, but these markets provide better protection, downside protection in a recession. And obviously, deal fundamentals are critical as part of the underwriting and consideration, looking at the downside protection. As I talked in the past, or even in the previous slide, the preferred and common equity structure may present different benefits to different folks versus the common equity structure. So the deals that are happening, which is common equity structure, all investors that pari passu to each other, they get proportional amount of benefits, proportional amount of cash flow, proportional amount of depreciation, proportional amount of safety. The deals that are structured differently with preferred and common equity, for example, the allocations of benefits between investors are different. So preferred equity investors typically get seniority of the cash flow, and they get higher safety of the capital, which creates more downside protection, gives them more confidence to participate in the deal. Other folks don't mind participating in common equity. They will get all the depreciation benefits of the deal. They'll get potentially higher upside, but they're taking on more risk. So again, considering preferred versus common deals in this market may be more valuable than purely looking at common equity deals because you have more options. Well, I said there was a most important slide on the presentation was the debt term expiration and rate cap maturity. But my most favorite slide, this is the slide that I love, is this slide. It's all about smooth sailing versus roller coaster ride. And this roller coaster is the oldest wooden roller coaster. It's an old picture. This roller coaster is substantially older now. It's here in Brooklyn, New York. It's Brooklyn Cyclone. It's the oldest wooden roller coaster in the United States. It squeaks. It's scary. I don't enjoy riding that. I've ridden it a couple of times, and that's it. It's been years since I tried it. I'm too old for this. I certainly prefer smooth sailing. So the reason it's important is that you got to think about this all the time, and now even more than before. So folks that have concentrated portfolios that took too much risk, they are probably getting a little bit uncomfortable right now, and rightfully so. So building a well-diversified portfolio and taking appropriate level of risk is something that most investors need to think about. Here's some examples of diversification. These are snapshots from, I believe, Temple Opportunity Fund, one of the recent quarters. And it just shows that as fund managers, we do this, and you as investors should consider doing the same. Think about your portfolio. What do you got? Where do you have your money deployed? Are they spread among many strategies, locations, asset classes, and so on? This is an example of geographic diversification. This is an example by different sponsor and operator. Again, spreading your risk among many folks is the way to go. Investment quadrants. I've talked about this so many times. I'm just going to repeat a little bit. I don't want to spend a ton of time on this. This comes into play even more now than ever before. The reason it's important is that you have to think about where's your portfolio, what investment quadrants you've written your checks into, or you will write your checks into. So something to keep in mind. So quadrant 1 and 2 are your investment grade quadrants. They have better downside protection, and they have low to moderate risk. And then the quadrant 3 and 4 are more speculative grade quadrants. These quadrants have a lot more risk. And the quadrant 1 and 3 are your cash flow quadrants, and the quadrant 2 and 4 are your growth quadrants. You know what's really amazing and fascinating is this. I had a conversation with an investor. An investor says, well, how do I mitigate all the risks of a file, losing all my capital on a given file, and how much should I allocate to these losses? Well, the answer is it depends what you have in your portfolio. If you bought projects in the quadrant 3 and 4, and these projects beginning to go bad, well, don't be surprised. I mean, I hate to put it, these projects have risk. And in a good market, when things are going well, these projects generally outperform and they generate higher returns. But in a bad market, when the economy starts contracting and there is a possibility of a catastrophic loss of capital, you could lose the entire dollar of that investment. So having a lot of money in quadrant 3 and 4 creates a risky portfolio that's loaded with risk. And what are these deals? People have asked, what are these deals that have a lot of risk? Well, look at the basic stuff. The quadrant 3 and 4, typically your junior lien notes. So mezzanine debt could be junior lien, and you have to be comfortable investing in mezzanine debt. Under some circumstances, can do really well. Mezzanine debt can actually lose money. So mezzanine debt, junior debt, secondary debt, generally fall into quadrant 3. Not on every deal, but as a rule of thumb. Highly leveraged equity deals. Obviously, when you're in equity in a deal and it's cash flowing well, imagine you have long-term maturity, and from a good cash flow, the deal could suddenly be no cash flow, short-term cash, right? So the financial elements of the deal matter, but quadrant 3 and 4 deal have that risk. And then deals, new development, redevelopment, land speculation, high value adds, they all present risk. When I have a value add, if you didn't execute value add well, the deal could collapse because the value add didn't perform the way it was supposed to. It was supposed to renovate the property, but the renovations didn't complete. They didn't get the target rents to where they need to be. There are risks. And the reason I'm saying this is that you have to think about where did you write each of your checks in your portfolio. We'll talk about that. The quadrant 1 and 2 deals, they have risk too. They're not risk immune. However, their risk substantially lower. So deals in quadrant 1 and 2 don't have the same risk profile where a big number could be associated with loss reserves. So example, in a quadrant 1 and 3 deals, generally speaking, loss reserve. The way to think about loss reserves is how many deals out of 100 on average could go bad. Quadrant 1 and 2, they're generally between 1 and 3%. It doesn't mean that you can't see more, you certainly can. But mathematically speaking, on average, you're not going to see gigantic losses in quadrant 1 and 3. The quadrant 3 and 4, the general loss reserve, your average loss reserve is somewhere in the 6% range, but you may have a lot of variance between 5 and 20%. So in a bad economy, you may have 20% of your deals going bad. You lose all your money on those deals. And could be even more, right? Depending on the deals, depending on the market conditions, location, strategy. So the reason these quadrants just matter is because they're fundamental, something to think about. The reason I'm using it in our funds, where we're using it, and the reason this has become an educational concept is because they work. The concept makes sense. So what does your portfolio look like how much capital have you allocated to quadrant 1, 2, 3, and 4 in each quadrant? Think about it. So if your portfolio is allocated heavily into quadrant 1 and 2, you're probably sleeping pretty well. I mean, you know you have risk exposure to quadrant 3 and 4, but it's not a big exposure. So again, there's no right or wrong, but if you've done your kind of planning well, you probably don't have a heavily leveraged portfolio into quadrants 3 and 4. And if you do, well, you need to know what you got. Sometimes going to the doctor is painful, but if you don't go to the doctor and you got problems, the problems don't necessarily go away. So you can't ignore it. You have to understand what you got. So we'll talk about it, but understanding where your deals, what quadrants they fall into, is of paramount importance, so that at least you can prepare and deal with it. So how do you manage your portfolio in a recession? You manage it a few different ways. Number one, you basically have to look at each investment and you track it on a quarterly basis. How is it doing on operating, financial basis, and as well as what risk and stress points is it dealing with, or they are upcoming. And there's no easy way to do this. It's just go one by one and understand operating, how are they doing versus the plan? Are they underperforming or performing the plan? Same thing on the financials. Are they operating on pro forma basis or they're lagging behind? And then the risks, one of the basic questions to ask, hey, what's happening with the mortgage on this property? When is the mortgage maturing? Is it fixed rate debt or variable debt? And when is its rate cap is expiring if it's variable rate debt? And what's going to happen when it's expiring? Are you prepared, Mr. Operator, sponsor? Are you prepared for this? What are you thinking is going to happen? So these questions are not easy, but they're important to ask. Obviously, pay attention with monthly tracking to large investments. So if you roll big checks into anything, track it more often than quarterly basis. If it's doing well, that's wonderful. Concentrated investments. So you may have concentration in a certain strategy. Is that strategy doing well? Or you have concentration in a certain location. Is that location doing well? It's very important to just know what you got, especially where you have big checks and concentrated checks. And obviously look at the underperforming and distressed assets. What's happening with them? Follow frequently with the operator or sponsor, get a better understanding. And the reason you need to know is because you need to understand the health of your portfolio, and we'll cover that mathematically in the next slide. Consider increasing loss reserves and cash reserves. Now, these will not necessarily solve every problem out there, but cash helps. So loss reserve, simply a mathematical figure that prepares for a greater degree of losses. And then cash reserve is real cash. You just build up your cash positions, and you are prepared with cash if there's a capital call in the deal, or you need to provide additional financing. Cash also becomes ammunition when you have a new great deal coming into play. So having cash and having access to cash reserves is very helpful at this stage of the game. How do you stress test and winterize your portfolio? Well, you have to look at each investment first. What quadrant it falls into? Pretty basic stuff. If you don't understand how to do it, feel free to reach out. Happy to provide some guidance and help. Again, the methodology is educational. It's not perfect. You may have deals that are borderline. Some deals may be between 1 and 3, and some deals may be between 2 and 4, right? They're borderline projects. So you have to understand, or at least estimate where each quadrant falls. And then you can use green, yellow, and red, basically scoring system to look at each of your deals. And you're going to look at the operating review, as I mentioned, performance versus original plan, financial review, cash flow, and NOI, reserves, so on and so forth. As I mentioned, long-term and maturity and rate cap maturity. What is the plan to mitigate risk in yellow and red investments? This is something that you can ask the operator, sponsor, fund manager, whatever problems, how are they mitigating risks? Sometimes they have a good answer, sometimes they don't, but this is the type of question you need to ask. And yet you should estimate your likely loss for yellow and red investments. You can even estimate for green. Green should not generate you a lot of loss, but you can still assign a small loss factor to that. But yellow and red should be given some kind of a projected loss factor. And the way to think about this, just say you have 5 deals that are going bad. You may say, well, I think 20% are going to lose all the money. Then you basically assign that. Of the 5 deals, one of them loses all the money, so you have to write off that entire investment. Be prepared for this. And estimated cash liquidity that these deals might need, something that may help you plan. So you can talk to an operator sponsor and say, hey, are you planning capital call? You don't want to get the capital call and not be expecting it at all. What you want to know is, hey, the capital call is likely going to happen in 3 months because we're going to hit term maturity. We're going to need some cash. So for every dollar you invested in the deal, we expect another 20 cents. Means a 20% capital call. People have to bring the additional cash into the deal, otherwise the deal may not survive. So it's important consideration for folks to keep in mind or plan for it. Here's what you can do. Are you recession ready? Do you understand your portfolio? So this is an example. Your portfolio is, say, 60% quadrant 1 and 2, and you don't expect a lot of loss. Here I put 0. It probably could be a number, like a small number. So these type of deals don't expect to lose a lot as far as they're concerned. Now you go look at the yellow, and you have 30% of your portfolio is in yellow, and 1 in 5 in those deals will lose money. So this is just an example. So 1 in 5 means that 30% times 1 in 5 simply means it expects to lose 6%, or the entire portfolio could be lost on these yellow deals. And reds are worse. Say 10% of your portfolio are quadrant 4 and 3 and 4 deals, and half of them are expected to lose the entire capital. Now, this is not a pretty picture. This is not a comfortable picture, but it is a realistic picture, something that you can actually prepare for and prepare and project. And cumulatively, you could say, hey, I looked at the portfolio. I expect to lose 11% on the red and yellow deals. But then you could say, hey, on the green deals, they should still generate me a return of 11% or 12% or 10%. So overall, the portfolio might break even, but it depends on the composition of the portfolio. So back to the question, are you recession ready? If you looked at your portfolio and you have an idea what you got and how is it prepared, how is it dealing with the issues? So now we're just going to go back and talk about some fundamental principles. You can't fix what you got, right? I mean, without understanding what problems you got. Say at the moment you're dealing with a portfolio and you've got certain issues and you're going to fix them. But now maybe the time to reevaluate your goals. Should be doing this from time to time anyway. What are the goals for your portfolio? And these goals could change over time with life events and other changes. Life is dynamic. So the number one goal to think about is what's your risk reward tolerance? Can you sleep well at night by taking the risk? And folks have taken the risk in the past, might have done well, but now their risk profile could have changed. And the forward basis don't want to have any more quadrant 3 and 4 deals because it's too much risk and they can't sleep well. And now this recession is driving them insane. So something to keep in mind that you may want to be repositioning your portfolio. Now, if you got quadrant 3 and 4 deals and you got a lot of them, you can't really get rid of them. It just there's no secondary market, especially, well, some deals you may be able to sell, but if you sell, they could be sold at a steep discount. So on a forward basis, you control what cash you put to work. And at least you have the opportunity to adjust your portfolio and adjust your goals. But here are the goals. Again, risk reward tolerance, how much cash flow you need, your total return targets, your tax efficiency, how much depreciation you need, how much diversification you need, how comfortable you are with risk. So diversified portfolio may give you much more predictable results. And some folks have looked at the bright and shiny objects and looked at deals with great target returns, but they weren't diversifying as much. And now they may be sitting there and saying, wait a minute, I don't want to be so concentrated in some of these higher risk deals. Time horizon, so typically how much time you are looking to invest for, and then liquidity. Some deals have liquidity, some deals don't have liquidity. You have to know what are your liquidity goals. Here's an example of a growth-oriented portfolio. You may be totally comfortable. If you're younger, you still have your business, you're running your business, you are enjoying many more years of active income. You may have higher risk reward tolerance. So you're looking to maximize risk adjusted return. Cash flow basis, you may not need cash flow today. If you have IRA money that doesn't need you're 50, you're 52, you're 53, you don't need the money for 6 years or 7 years. You can invest into something that has no cash flow requirements. Total return target, what you're looking to generate as a return in your portfolio. What is your tax efficiency? Some folks look for tax efficiency, some folks don't care. Diversification. So what do you want to spread your risk among, and what are your rules of investment? And you really have to understand what you're investing into. Diversification doesn't mean writing equal check into 100 or 20 or 30 different things. Some of those things may be more diversified by themselves and some are risk concentrated. Just understanding these assets and how many of them you want to invest into. So 20 to 30 assets is an example. And you may say, I don't want to invest any more than 10% of my portfolio into anything, which is an absolutely valid argument. So your diversification goals are important. Obviously, time horizon and liquidity requirements. Again, this is an example. That's about it. Appreciate your time and attention. Hope you enjoy this presentation. Hope you learn a few good things. I'm here to answer your questions, and we are looking forward to have some really interesting deals coming in 2023. Right now, we're very patient. We're sitting and waiting for great deals. We're certainly making some investments into strategies that continue to operate well even in this environment. But we're sort of in this quiet, get ready, load your gun, be ready, prepared period of time on new deals. So we'll keep you informed when great deals start coming up. Would love to bring them forward when they're here. When we find these great opportunities. On the existing investment fronts, on our funds, we'll have another presentation, what we're doing. We'll dive into great depth into basically the analysis that we're doing, the new folks we're bringing on board to do more and better analysis on our investments, communicate with every sponsor in great depth, more frequent, what we can do to help them, and try to solve problems before they hit, and when they hit, try to solve them if we can. So as fund managers, we are very proactive about it. We're trying to prepare, and that's what the game is now. It's not going to be necessarily a easy, fun, super exciting journey forward for existing portfolios of assets. It's going to be roll up your sleeves, manage the portfolio, survive, do well, and then on new deals, the returns should be better because they're being bought at a better discount. So again, hope this makes sense. Appreciate your time and attention. Looking forward to hear from you, and have a great day. Thank you.